Hey there, Iguana Nation. Iggy here, and boy do I have some juicy news for you today. In this video, we're going to dive deep into Mapletree Pan Asia Commercial Trust's latest financial results. Trust me, you won't want to miss this. Picture this: Mpact just reported a tasty 8.8% rise in Q4 DPU. That's cold hard cash heading straight into investors' pockets. Ka-ching. But wait, there's more. Mpact is also sitting on a massive $1.5 billion mountain of cash. So what does this all mean for savvy investors like you and me? Well, buckle up, Buttercup, because I'm about to break it all down for you. With that hefty cash stash, Mpact has the power to pounce on juicy new investments and acquisitions. More properties equals more rental income, which puts a big fat smile on unit holders' faces. Stick around, because next we'll take a closer look at Impact's secret sauce and see what makes this commercial property powerhouse tick. Trust me, you won't want to miss it. To begin with, we need to understand the concept of distribution per unit, DPU. In the world of investments, particularly in the context of trusts and funds, DPU is a critical term. It refers to the amount of money that investors, also known as unit holders, receive for each unit they own in a fund or trust. This distribution is usually made from the profits generated by the fund or trust. Now, let's consider the case of Mpact, a hypothetical entity for our discussion. In the fourth quarter, Mpact reported a growth in its DPU. Specifically, the DPU increased by a solid 1.8% compared to the same period in the previous year. This growth rate is a positive sign, as it indicates that the entity has been profitable and that these profits are being distributed to the unit holders. So, what does this mean for you as a unit holder? If you held units in Mpact, this growth in DPU translates to an increase in the amount of money you receive as a unit holder. In other words, your payout, which is the money you receive from your investment, would have seen a nice little boost. This increase in payout is one of the ways investors earn a return on their investment. The DPU is a key indicator of the performance of an investment in trusts or funds. An increase in DPU, like the one experienced by Mpact, is a positive outcome for unit holders as it means a higher payout. Let us review the financial performance of Mpact. Firstly, we need to understand two key financial metrics: gross revenue and net property income, NPI. Gross revenue is the total amount of money that a company generates from its operations before any expenses are deducted. It's a top-line figure that gives us a sense of the total market demand for a company's products or services. In the case of Mpact, the gross revenue grew by 2.6% to reach $239.2 million. This growth in gross revenue indicates that Mpact has been successful in increasing its total sales or service charges, which could be due to various factors such as an increase in customer base, a rise in demand for its services, or successful marketing strategies. On the other hand, NPI is the income left over after all property-related expenses have been paid. It's a more specific measure that gives us a clearer picture of the profitability of a company's real estate operations. For Mpact, the NPI rose by an impressive 3.2% to $183.1 million. This increase in NPI suggests that Mpact has been effective in managing its property-related expenses, which could include things like maintenance costs, property taxes, and insurance. A higher NPI is generally a positive sign, as it means more profits are being retained for distribution to unit holders or for reinvestment into the business. According to Impact's management, these improvements in gross revenue and NPI were largely due to strong performance in Singapore and stable contributions from a significant asset in Hong Kong known as Festival Walk. This suggests that Impact's operations in these regions are doing well, contributing positively to the company's overall financial performance. While the company showed positive growth in terms of gross revenue and net property income, it also faced some challenges. One such challenge was an increase in net finance costs. These costs encompass various financial expenses that a company incurs, including but not limited to the interest paid on loans. In Impact's case, the net finance costs saw a significant rise of 10.8%, amounting to $56.4 million. This increase is a substantial one and can impact the company's overall profitability. Higher finance costs mean that more of the company's revenue is being used to service debt, which can leave less money available for other operational expenses, investments, or distributions to unit holders. The reason behind this increase in net finance costs was primarily due to higher interest rates on Impact's borrowings in two specific currencies, the Singapore dollar and the Hong Kong dollar. Interest rates can vary based on a multitude of factors, including the economic conditions in a particular country, inflation rates, and monetary policy decisions by central banks. In this period, it appears that the interest rates for these two currencies rose, leading to higher costs for Impact's borrowings. Firstly, let's discuss the distribution per unit, DPU. For the full year, Impact's DPU was 8.91 cents. Interestingly, this is a decrease of 7.3% from the previous year's DPU of 9.61 cents. This decrease in DPU might initially seem concerning as it means that the payout to unit holders has reduced compared to the previous year. The management of Mpact explained that this decrease in DPU was primarily due to higher interest rates. As we discussed earlier, higher interest rates lead to an increase in net finance costs, which can impact the amount of profits available for distribution to unit holders. In Impact's case, these higher interest rates affected the full-year payout, resulting in a lower DPU. However, it's not all gloomy. There were some bright spots in Impact's annual performance as well. The company's gross revenue for the full year grew impressively by 16% to reach $958.1 million. This substantial growth indicates a strong demand for Impact services or products over the year, reflecting positively on its business strategies and market position. Similarly, the net property income, NPI, which is the income left after property-related expenses, also saw a significant rise. It increased by 15.2% to reach $727.9 million. This growth in NPI suggests that Mpact has been successful in managing its property-related expenses and generating profits from its real estate operations. Portfolio occupancy is a crucial metric in the real estate industry. It represents the percentage of a company's properties that are currently leased out to tenants. A high portfolio occupancy rate indicates strong demand for a company's properties and is generally a positive sign, suggesting that the company's real estate assets are being effectively utilized. As of March 2024, Impact's portfolio occupancy stood at 96.1%. This figure, while slightly lower than the 96.7% reported at the end of 2023, is still higher than the 95.4% recorded a year ago. This year-on-year increase suggests that Mpact has been successful in leasing out more of its properties, which could be due to a variety of factors such as favorable market conditions, effective marketing strategies, or the attractiveness of its properties. The management of Mpact attributed this improvement in portfolio occupancy largely to their success in filling up space in one of their properties, known as M-Tower. This could mean that M-Tower has features or amenities that are particularly attractive to tenants, or that Impact's leasing strategies for this property have been particularly effective. In conclusion, while Impact's portfolio occupancy has seen some fluctuations, the overall trend is positive. However, it's important to remember that real estate markets can be volatile and influenced by a wide range of factors. Therefore, while a high portfolio occupancy rate is generally a good sign, it's always important to consider other factors and indicators when evaluating a company's performance. The CEO also highlighted that their flagship property, Vivo City, had an amazing year. It hit a new record in tenant sales, which helped Impact's overall portfolio achieve an impressive 14% rental uplift. Impact's manager seems pretty confident about their financial position. They've got a gearing ratio of 40.5%, which is a measure of their debt compared to their assets. They've also got an average term to maturity of debt of 3 years, which means their debt repayments are spread out over time. Plus, they've got around $1.5 billion in cash and undrawn committed facilities available. That's a nice chunk of change to have on hand for any working capital needs or financial obligations that might come up. The CEO wrapped things up by emphasizing that Impact's Singapore assets have been consistently delivering the goods. She said that given Singapore's stability, it will remain a big part of Impact's assets under management and NPI, which reinforces the REIT's foundational strength. So there you have it, folks. Mpact seems to be navigating the choppy waters of the current market pretty well. They've had some solid growth, and although higher interest rates have taken a bite out of their DPU, they seem to be in a good position to keep chugging along. Well, there you have it, folks. Impact's Q4 results are in, and it's looking pretty solid. A rising DPU and a massive cash stash are definitely things to get excited about. But remember, investing is a marathon, not a sprint. Always do your own research and consider your personal financial goals before making any big moves. If you found this video helpful, give it a big thumbs up and don't forget to subscribe to the Investing Iguana channel. I've got plenty more financial wisdom to share with you, and I don't want you to miss out. Also, I want to hear from you. Leave a comment below and let me know what you think about Impact's results. Are you an Impact investor? What's your take on their future prospects? Until next time, Iguana Nation, keep investing wisely and always stay curious. Iggy out.